So this morning, the Bureau of Labor Statistics came out with July's PPI numbers, the Producer Price Index. So what is the PPI and how does it differ from the CPI, Consumer Price Index? That's where I began my conversation with Stephen Cates, financial analyst for Bankrate.
The producer price index is really the costs that producers are seeing. So similar to the consumer price index, which is what prices consumers see, this is on the producer side. And, that doesn't come up as much. One, because it's not as close to home as consumer price index. When you and I or any of the viewers go to the grocery store, the consumer price index is what informs what they see. Whereas the producer price index is kind of, that's been a precursor. That's happened already. And it doesn't necessarily hit each of our individual wallets. So a lot of people don't pay attention to it as much as, your average, sort of grizzled economist might.
The PPI rose 0.9% in July and at an annualized rate of 3.3%. How does that stack up against what economists had expected?
It is nearly 4 times higher than what economists expected. So, what's interesting about this is not so much what's in the report. I think there's interesting details in there, but just the fact that this is so massive relative to what was expected. This is higher than every single forecaster's assessment that Bloomberg, sort of collects in their surveys. So almost no one expected something this large. But to put this in context, it is just 1 month. This is not necessarily a persistent trend that we're seeing. These things can be very volatile. The producer price index is more volatile than the consumer price index. And so, this doesn't necessarily mean that we immediately are going to start seeing massive price increases across the board. We've got to take this month by month and just monitor this and other data points to get a sense of what's really going on and how this is going to impact the consumer.
Do you think tariffs played a role in this increase? And if so, why is it maybe more pronounced in this report? I know you mentioned that this is a more volatile report, but it seems to be, if that's the case, that tariffs were the responsible for the increase, that it's certainly seen largely here rather than the CPI.
So are tariffs impacting this? Yes. Are they solely responsible for this? No. One of the big areas that actually pushed up the PPI in July is services. We saw airline prices rise. Those had been falling or stagnant for the last few months. Those rose precipitously. We also saw, other details within the service environment, including, there's machinery and wholesale trade and all these other things that sort of get baked in there. It gets, a little bit detailed and not terribly interesting, but, services is what pushed this up. That was up 1.1% month over month. Goods prices rose less at 0.7% month over month. So while tariffs are going to impact goods prices more, and we certainly saw some increases in food prices, there isn't necessarily, we can't lay this at the feet of tariffs completely, although they are certainly impacting things.
And of course, the Federal Reserve takes a lot of this data into account with regard to decision-making about interest rates. How do you think they're going to read this, given that we also have a labor market that's weakening?
There is a bead of sweat appearing on Jerome Powell's face as we speak. This is not good for their decision-making, or what is assumed to be, the sort of done deal of a cut in September. So I'm expecting that the odds of a cut are probably going to come down from the sky-high expectations that they were at just this morning. But there's still a lot of data that is yet to come out. We're going to get another CPI report. We're going to get another PPI report. We're going to get another, personal consumption expenditure report, as well as other inputs that are going to sort of come into this, especially from the labor market. So you can't look at just this and say there's not going to be a cut, or there is going to be a cut. We've got to take all of this data into account and see where things sort of shake out. Another interesting thing that came out this morning is more on initial and continuing jobless claims. And what we're seeing from those is that we're mostly moving sideways. Initial jobless claims are roughly at the same rate that they were through 2023 and 2024. We were averaging about 223,000 initial jobless claims every week through those prior 2 years. We're roughly at that currently. And so that might sound like a lot, 223,000 people claiming jobless claims every week. It sounds like a lot, but we have 160 million people that are working in this country, in the labor force. So that isn't very much within the scale of our economy. And it's roughly where we've been for the last couple of years. So we're not in a terribly bad place from a labor market perspective. It's just that hiring is extremely slow. And that's something that is going to take time to work out, as businesses will need to develop a little bit more confidence of what's going to happen in the future. And that is hard as tariff rules are changing, as the tax bill that's come through has not yet taken effect. So there's a lot of moving parts here. But ultimately, what it comes down to is a little bit of a guessing game as to what the Fed might do and what businesses are going to do, even as the stock market hits all-time highs.
And I'm curious, because the stock market is where I wanted to go next. How big a deal is an increase in the PPI as compared to an increase in the CPI?
The stock market seems to be shrugging this off, for the most part. The PPI report is going to be a precursor to ultimately the prices that come down to the consumers. Some of this increase will likely flow through to consumers, but not all of it. And it's hard to predict how much of it, because it's going to differ by product. It's going to differ by, individual company.
Right.
And so it's hard to know, can we make a one-to-one comparison? We can't. Are tariffs going to pass down to the consumers altogether? Are they going to be split up amongst sort of the four entities that make up, the supply chain: foreign producers, importers, retailers, and consumers? All four of those are probably going to end up carrying a little bit of the burden of these higher tariffs, but it's hard to know how much and at what point each one is going to start to take on a little bit more responsibility.
So your assessment of the situation is that this maybe doesn't carry as much weight as a CPI increase would for Wall Street.
I don't think so. No. I mean, I think that, when an individual person, is going to actually get the CPI sort of front and center with what they're buying, that's going to feel a little bit more visceral. And it's certainly going to, decrease sort of the good feelings and the good sentiment that we may or may not have. On the producer price index, that's something that economists are looking at. The Fed is certainly looking at, Wall Street is seeing, but it doesn't have the same kind of pop as a high CPI report or a hot CPI print.
Bankrate financial analyst Stephen Cates, I appreciate you joining me.
Yeah, my pleasure. Happy to help.